Welcome to Market View with Ike Iosa and Friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Well, good morning. Mike Iosa, your host for Market View. Guest, my very good friend, Mr. Mark Arbeter. Hi, Mark. How are you?
Great, Ike. How are you?
I'm doing well. And Mark, I'm going to ask you the same question I'm asking all of my guests these days, which is October has a reputation of being a bear market killer. Have we seen the end of the bear market, or are we seeing just another bear market rally?
I've been looking for a counter-trend bear market rally at the very least. During the last low in October, breadth got really washed out. Sentiment got extremely bearish. Early in October, I thought we were going to start up, and we saw one more low. But we're starting to see, if we go to the first chart, the S&P 500, we're starting to see reaction to the bad news with higher stock prices. It's always the reaction of the news, not the news itself. So if one were to, tell us that, Microsoft and Google and Amazon, and I don't even, worry about Facebook and Apple, we're going to disappoint and tell us what the after hours reaction and the next day's reaction was going to be, I think every one of us would say, well, the major indices probably would have gone to new lows. So I think it's bullish for now that the market has been able to hold and start higher with some of this very bad news, especially with the heavyweight of these NASDAQ stocks on, the NASDAQ, the triple Qs, and the S&P 500 indices. So the first chart, we were in this down channel since we peaked in mid-August. We did see a couple minor bullish divergences on the daily chart, and then we broke out of this channel October 18th, came back, put in a flag, and then kind of took off again. We had a 513 EMA bull cross around the 21st and the 22nd. That was the first bullish cross from these two simple moving averages since way back in July when that rally got started. So let's go. We did break out of a small base, inverse head and shoulders here. So that's a good sign also. So we've completed a small base and we broke out of this short-term down channel. So if we go to the second chart, which is also a daily of the S&P 500, going back to the peak early in January, obviously, lower lows, lower highs, nothing has changed. There is a positive on this chart. We did have a false breakdown here in October when we went below the June lows. Sometimes false breakdowns and false breakouts can be significant. I would say, looking at this chart, there's clear resistance up near 4,100. That's where the downtrending bear market trend line comes in, as well as the declining 200-day. So if we go to the next chart, we'll get into more closer resistance. A 50% retracement of this decline since August comes in around the 39.10 level. That's also the bottom that we saw in early September, so there's some chart resistance there. And then the next piece of potential resistance up around 4,000, 4,010 area. And then you can see, the 200-day coming in at 4,100. So there's a ton of overhead resistance that we're going to have to deal with. It'll be interesting to see. A good sign would be if we just start cutting through pieces of resistance or pausing, not giving up too much, and then slicing right through it. Now, I'm not an Elliotician, but whether this is a completed ABC decline off the mid-August highs, or we've gone 1, 2, 3, and we're in wave 4. Wave 4 can't go above wave 1, the bottom of wave 1. So we should know soon If this is only a wave 4, then we would have one more wave down, at least for the bear market. Moving to chart number 4, we're going to spread this out to a weekly chart. As I've been saying, we had support down at that 3,500 area. That was a 50% retracement. We also had some chart support from back in 2020 in that area. And we had the very important 200-week moving average. And although we were below the 200-week a couple weeks ago, intra-week, we basically closed very close to it. So we really didn't take it out. So that was 3 weeks where we tested the 200-week and we held. I think that's, at least very important here as we move forward. We go to the next chart, chart number 5. I'll show you why the 200-week has been very important. This chart goes back to 1980. You can see that it held in 1987, 1990, then in 2003, 2004, 2011, 2016, and 2018. And so far, we've held here in 2022. So this longer-term moving average has been very important for the S&P 500 and will be in good shape as long as the 200-week holds. So moving to chart number 6, this is also a weekly chart of the S&P 500. Another piece of support came in near that 3,500 area was the trend line off the lows since 2011, also off the 2018 lows. So we're still in this upper channel here. If we were to break this upper channel, the 3,500 area, I think clearly the next strong piece of support, which would be a 61.8% retracement of the rally off the pandemic lows, and the trend line off the 2009 and pandemic lows would come in around 3,200. That's a very common number when speaking with many technicians out there. That's a simple one to come up with. So moving to chart number 7, this is the NASDAQ on a daily basis. The NASDAQ also had a false breakdown in October. But you can see the NASDAQ really looks like an inverse head and shoulders here, late September into early November, but we haven't even broken out of that inverse head and shoulders like the S&P 500 has. We did put a couple bullish divergences on daily momentum with respect to the 14-day RSI, the MACD histogram, and then the MACD versus the signal line. If you go to the bottom panel, you can see that since the August high, the NASDAQ, the line going down, the NASDAQ is underperforming the S&P 500. And in fact, if we go back to December of 2021, almost a year ago, both the NASDAQ and the triple Qs have been underperforming the S&P 500. I'm sure I don't have to tell that, to too many people. The tech stocks have really gotten killed here, and the higher beta stocks as well. So certainly that has not been the place to be. It led on the upside. Now it's certainly leading to the downside. Looking at chart number 8, this is a daily of the triple Qs going back to its peak back in November of 2021 and secondary peak right at the beginning of this year. False breakdown on the triple Qs as well. But still hasn't broke out of this potential and very small inverse head and shoulders that could be tracing out. We look at the panels on the bottom. We'll start with Apple. These stocks on these lower panels are the 5 largest stocks in the S&P 500 and the triple Qs. I think they make up a little over 40% of the triple Qs, maybe 20, 21, 22% of the S&P 500. So very, very important. Apple's probably the best chart, kind of sideways action, basically right in the middle of the range. Note that it did not go to bear market lows when the Qs did, and it's rallying back up to its 200-day moving average. So fairly neutral on Apple. The other ones, I really can't say that. They've been in decline since December, November of last year. We'll look at Microsoft, below its 200-day, went to new bear market lows in October. Amazon testing its bear market lows from June. Consistent downtrend below its 200-day. Google went to new lows, new bear market lows here in October, and consistent downtrend below its 200-day. And Tesla basically tested its June lows. It's trying to hold here, but still on a clear downtrend and below its 200-day. So really for the Qs, XLK, the kind of tech index, these guys got to demonstrate some leadership, put in some bottoms here, and we seem like we're a long way from them doing that. We go to chart number 9, switch it up here, go to the 10-year Treasury yield. You know, besides the big tech stock hurting the overall indices, including the S&P, the relentless climb in yields, not only on the 10-year, but going all the way across the yield curve down to short rates, has been something to watch. We got to 430 plus about a week ago. We did pull back a little here on the 10-year. We're right at the initial probably support around 4%. That was the prior high here in late September. Trendline support is in there, as well as the 50-day moving average. So I think to really get going here on the downside, we probably have to take out the 350 level. That's the prior high here from June. It's also trendline support off the December lows. So to see any kind of real downside, which would certainly help the stock market, probably have to get below that 350 area. But any pressure on rates would certainly go a long way in at least supporting the stock market to some degree. Chart number 10 is also an issue, has been an issue for stock, consistent rise in the U.S. dollar index. We're at a key spot here, 109, 110 area. I think we're about 110.80 right now on the dollar. This is a day-old chart. Now we put in a lower high, a lower low, very minor, and this could be just a simple ABC, and then we take off again. But I think the key spot here is that 109 level. That's the prior high from July, and then we got this trend line off the lows since February. But it would certainly help the U.S. markets, I think, especially the large caps, do a lot of business overseas, and it would certainly help, get precious metals off their back as well as emerging markets.
Okay, Mark, anything else you'd like to add?
Yeah, the last chart 11, goes all the way back to 1980, and this looks at the 2-year Treasury yield, which is the red line, and the Fed funds rate, which is the black line. I've said it ad nauseum that market rates generally lead what the Federal Reserve does, and we can see rates started up well before the Fed here in 2021. They did the same thing back in 2011, 2013, and the Fed typically plays catch up. Now, I don't know why stock chart shows the Fed funds rate at 256. Right now, the target range is 3 to 3.25. If they hike 75 as expected next week, we'll be at a 3.75 to 4% Fed funds target rate or target area. And we're getting pretty close to the 2-year. 2-year is sitting at 4.30. Now, I will note that sometimes when Fed funds catches up to the 2-year, the 2-year will have been going sideways or will kind of put in a top. We did see a V-top here in 2018, but it would sure be a lot clearer where the Fed's going to end here if the 2-year would start going sideways. I don't think the Fed would push the Fed funds rate too much further than where the 2-year is. So something to watch. Certainly be very bullish, as I think everybody's, looking for the Fed to go even further than that, perhaps up to 5%. I don't think that's going to happen, but we'll just have to wait and see. But it is encouraging here that the Fed is finally catching up to the market rates. And with another hike or two, we will be there.
Mark, thank you. Have a great weekend.
Thank you, Ike. You too.